Looking to supercharge your portfolio with serious growth? Today we're putting two of the best growth ETFs head-to-head, VUG and SCHG. Together, they manage over $100 billion in assets and hold some of the biggest names in tech and beyond. But which one is the smarter choice for your money? Stick around because I'm breaking down the key differences that could help you decide where to invest for maximum long-term returns. Growth investing is one of the most powerful ways to build long-term wealth, and two ETFs stand out from the crowd, VUG and SCHG. Both are designed to capture the growth potential of large-cap companies, especially in sectors like tech and healthcare. VUG from Vanguard focuses heavily on innovation and has exposure to around 300 top U.S. companies, while SCHG from Schwab offers a broader sector mix and a slightly lower expense ratio. But how do you choose between them? In this video, we're going to compare their performance, holdings, fees, and more to help you understand which ETF best aligns with your investment goals. Whether you're all about high growth or looking for balance with lower fees, this comparison will give you the clarity you need. If you want more tips on building wealth, hit the subscribe button. Your support helps us create more valuable content for you. Let's dive into VUG, the Vanguard Growth ETF, a true giant in the world of growth investing, with a whopping $136.475 billion in net assets. At $375 per share, this ETF gives you access to some of the fastest-growing companies in the U.S., and it's heavily weighted toward tech innovation. If you're looking for an ETF that captures the explosive potential of big-name companies like Apple, Microsoft, and Nvidia, then VUG is right up your alley. In fact, VUG's top 10 holdings, which make up nearly 60% of the fund, read like a who's who of the tech world. Apple alone accounts for 12.90%, followed by Microsoft, 12.40%, and Nvidia, 10.91%. But it doesn't stop there. You also get exposure to heavy hitters like Amazon, Meta, and Alphabet. This fund is designed for investors who want high-growth, tech-driven stocks with the potential to deliver serious returns. And speaking of returns, VUG has had a stellar performance this year, with a year-to-date return of 21.14% and an incredible one-year return of 31.92%. Over the long haul, this ETF has averaged 18.50% per year over the past 5 years, and its 10-year average return is a solid 15.06%. So, if you're after long-term growth and aren't afraid of a little volatility, VUG could be your best friend. Even though VUG is focused on growth, it also gives you a little bonus with a dividend yield of 0.50%, paying out $1.88 per share in the last year. The real star here, though, is the capital appreciation. And with an ultra-low expense ratio of 0.04%, you're getting all this growth potential without sacrificing much to fees. If you're in it for the long haul and want to ride the wave of tech and innovation, VUG is a serious contender. Let's imagine you're investing $100,000 today in VUG. With a 5-year average annual return of 18.50%, your $100,000 investment would grow to $235,984 after 5 years, and you earn approximately $2,500 in dividends. If you stayed invested for 10 years, your portfolio would expand to $405,066, and your total dividends would be around $5,000. Looking at a longer horizon, after 20 years, VUG could grow your investment to $1,641,072, and the dividends would accumulate to about $10,000. And after 30 years, that initial $100,000 could potentially reach a massive $6,647,889, and your total dividend earnings would be a substantial $15,000. That's the power of long-term investing and compounding growth. Now, let's turn to SCHG, the Schwab U.S. Large Cap Growth ETF, a powerhouse of growth with a total of $31.741 billion in net assets as of September 2024. Priced at just $101 per share, this ETF offers access to some of the largest and fastest-growing companies in the U.S. With an expense ratio of only 0.04%, SCHG provides serious growth potential at a very low cost, making it a great option for long-term investors looking to maximize their returns without paying hefty fees. SCHG is packed with top-tier names, especially in tech and innovation. Its top 10 holdings, which make up over 60% of the fund, include giants like Microsoft, 12.18%, Nvidia, 11.88%, and Apple, 11.54%. Other key players in the fund include Amazon, 6.23%, Meta, 4.12%, and Alphabet. These are companies leading their industries in everything from cloud computing to artificial intelligence, making SCHG a great way to tap into the cutting edge of U.S. growth stocks. Performance-wise, SCHG has been absolutely crushing it in 2024, delivering a year-to-date return of 22.95% and a one-year return of 34.30%. But it's not just about short-term gains. Over the past 5 years, SCHG has averaged 19.87% annual returns, and its 10-year average stands at an impressive 16.28%. That makes SCHG a long-term growth machine, perfect for investors looking to ride out the market's ups and downs while capturing the growth of some of the biggest companies in the world. Even though SCHG focuses primarily on growth, it still offers a small dividend yield of 0.43%, paying 42 cents per share in the past year. And while the dividend might not be the star of the show, the capital appreciation more than makes up for it. With SCHG, you're getting an ETF that's geared towards long-term growth with low fees, backed by some of the most innovative companies in the world. If you want to grow your wealth by investing in the future, SCHG could be the right choice for your portfolio. Let's imagine you're investing $100,000 today in SCHG. With a 5-year average annual return of 19.87%, your $100,000 investment would grow to $246,973 after 5 years, and you earn approximately $2,150 in dividends. If you stayed invested for 10 years, your portfolio would expand to $453,960, and your total dividends would be around $4,300. Looking at a longer horizon, after 20 years, SCHG could grow your investment to $2,063,716, and the dividends would accumulate to about $8,600. And after 30 years, that initial $100,000 could potentially reach a massive $9,385,869, and your total dividend earnings would be a substantial $13,000. That's the power of long-term investing and compounding growth. Now that we've explored both VUG and SCHG, let's compare them side by side across the key factors. Both ETFs focus on large-cap growth stocks, but their approaches differ slightly. VUG holds around 300 companies, offering broader exposure to growth opportunities, while SCHG is more concentrated, with fewer holdings, but still includes top-tier names in tech and innovation. When it comes to fees, both ETFs are equally impressive with an ultra-low expense ratio of 0.04%, ensuring that you're paying minimal fees and maximizing your returns over the long term. In terms of performance, SCHG edges out VUG in recent returns, boasting a 22.95% year-to-date return and 34.30% one-year return, compared to VUG's 21.14% year-to-date and 31.92% one year. Over the long term, SCHG has averaged 19.87% over the last 5 years, while VUG has delivered 18.50%, making both strong contenders for growth investors. But SCHG shows a slight edge in performance. As for top holdings, they share many of the same names, with Microsoft, Apple, and Nvidia making up significant portions of both ETFs. However, SCHG holds a more concentrated position in its top companies, with 60.25% of its assets in the top 10, while VUG spreads its assets more evenly at 59.46% in its top 10. Both are excellent choices for growth, but your decision may come down to whether you prefer VUG's broader diversification or SCHG's stronger recent performance. In conclusion, both VUG and SCHG are exceptional growth ETFs. But the right choice depends on your investment goals. VUG offers broad diversification, while SCHG delivers slightly higher returns with concentrated exposure to top-performing companies. No matter which you choose, both have the potential to seriously grow your wealth over the long term. If you found this video helpful, be sure to like, subscribe, and hit the notification bell so you never miss more tips on building your investment portfolio.